Welcome to the SDA Housing Podcast, brought to you by Ndis Property Australia. Before starting this episode, we need to provide a general disclaimer. Information contained in this podcast is general in nature only. It does not take into account the objectives, financial situation, or needs of any particular person. You need to consider your financial situation and needs before making any decisions based on the information in this podcast. And you should consider seeking independent and professional advice for your personal circumstances. All right, let's begin.
Hello everybody, my name's Debbie and I'm with Minh from Ndis Property Australia, and you're listening to the SDA Housing Podcast, a show that explains, highlights, guides, brings awareness about all things SDA in this ever-changing Ndis world. However, Minh, we're not talking about SDA today. What are we talking about?
No, we're not. We're talking about the rules have just changed as per the Labor government's legislation. The topics are really negative gearing, CGT and SMSF lending ban. So they're the three major topics, I guess, Debbie. Yeah, so no SDA talk today, just a simple chat about this topic, because in the news the last month and a half or 2 months is all about these topics only, yeah?
Yeah, so just give us a run through how it happened. We had budget night,
which was, I think, the 12th of
May,
I think, yeah. So it's the biggest shake-up to the property taxation topic in a generation. So negative gearing is now restricted. The 50% capital gains tax discount has been abolished. And then just to make things more of a headache, while we were all sleeping, about 2 weeks ago, the government came out with a deal with the Greens and late night deal with the Senate deal in June. They banned the SMSFs from borrowing to buy residential property. So
and we've now got a date on when that's going to take effect.
Yeah, basically about 4 weeks from now. Well,
10th of August.
Whenever we publish this episode, but 10th of August is basically it. Yeah, that's my feedback to your question there, Debbie.
Yeah. So we know what happened. What does it actually mean? So there's three things. One is that negative gearing is limited to new builds. 2, the 50% CGT discount is replaced. And 3, of course, the no more lending for property in your SMSF. So tell us about the first two things in a bit more detail. What does the negative gearing thing affect?
So the government's basically forcing us, if that's the correct word, to investors to only buy, build brand new property. I think it's their way of trying to release or give back more stock to the market of first home buyers and forcing investors to only buy or build brand new houses, townhouses and apartments. That's the reality of it all, right? And in a way, that has a massive effect on the buyer market. And we're seeing all the news in the auction clearance rates on the news every night for the last 2 or 3 weeks now. And essentially means, if you're buying old property from now on, as of, you got a year. There's a year window where
it's the 1st of July 27. It comes into effect.
So for now, it's as per normal for next year. But after July 1, 2027, then you cannot claim any more negative gearing tax benefits at all for established property at all. All those investors who have an existing property before the 12th of May 2026 can retain those negative gearing tax benefits there. That's fine.
So it's grandfathered in.
Yeah, exactly. But from now on, you can buy established property fine for the next year or so, and that's it.
What about the whole capital gains tax discount changing?
Well, it is. The capital gain.
It's 50%.
And if it's held for more than 12 months, it's 50% discount added to your income as you added to your marginal tax rate, and you pay your 30 or 42% or 46% tax rate on the capital gain. That's essentially what it is, and it's been replaced with this indexation calculation formula, so which is slightly more. I'll use the word slightly more, not a lot, so slightly more expensive than the existing CGT formula of capital gains tax. So that's also has a negative impact as well. They've also done other changes as well, which is minimum 30% tax rate in trusts, minimum tax rate on buying shares and selling shares as well. It's all very complicated. I don't want to bring that into this discussion today, but there's a lot of changes imposed by the Labor government to, and I'll say it bluntly, as a tax grab. That's what it all is at the moment, right? Yeah, that's my. And then lastly, lastly as well, no more borrowing on a LRBA, limited recourse borrowing, whatever the last terminology is, the last acronym. No lending for SMSF as of the 10th or 11th of August 26th. Now you can sign contracts executed by then, but if it's not signed contract by then you're excluded until the law changes again in the future. Yeah.
Yeah, and remember, this is only borrowing to buy property in your SMSF. If you're a cash buyer, it's not affected.
Yeah, exactly.
So what is the positive effect of negative gearing? What do you know? Let's talk about what it actually means. Who wins?
I don't know if there's a winner here, Debbie. The winner is the government.
Well, new builds, I guess. So developers and builders.
Well, even, I don't know. I mean, well, are they a winner? I mean, well, I guess in theory they are. I mean, if the government's forcing investors to actually go towards new builds, new apartments, new townhouses, new houses, then I guess there should be a pickup of construction of new properties, I guess.
I guess that's what the government are trying to achieve with this.
Yeah, exactly. But will it occur or not? I don't know. And I say this with caution because, Debbie, there's inflation, there's interest rate hikes, okay? And I'll say this. If you go to the Westpac website, I think there's a forecast of probably 2 more rate rises and then 3 or 4 more rate cuts over the next 2 years. Okay, so there's that factor there. Borrowing is going to be harder harder for consumers to actually get lending. So therefore, and also, Debbie, and I want to raise this for our listeners. A byproduct of the whole negative gearing removal is lower borrowing capacity. Okay, so Debbie, in the past, when lenders or finance brokers used to do their borrowing capacity, that was assuming add-backs was reading tax refunds and add-backs benefits was added back to the income, right, which allowed you more of a stronger borrowing capacity. So, but now with the removal of negative gearing tax benefits of older properties after 1 more year from now, it actually drops a borrower's borrowing capacity from down by 20 to 30% drop. That's a massive hit there, Debbie.
That is huge. So that really means that there's a lot of people that previously would have been looking to invest in property just no longer have that ability.
Correct. So investors who had example only, 800 grand maximum price to enter investment property, right? To buy a new or an established property, right? 800 grand maximum price now drops by about 240,000 down to 660.
And there's not a lot that you can get these days for that price.
Yeah. Now, in their infinite wisdom, the government thought, we'll do this to actually help the first home buyers and first home buyers, obviously, yeah. But it's going to backfire on the government, obviously.
Yeah, so I guess the capital gains tax, let's just look into that in a little bit more detail. So the 50% CGT discount for individuals, trusts and partnerships is being replaced across all capital gains tax assets held longer than 12 months. That's property, shares, everything, including pre-1985 assets. And it's being replaced by 2 new mechanics. So you did touch on these, but let's just explain these a bit clearer. The first one is the cost-based indexation. So what does that do?
Your cost base gets adjusted for inflation over the holding period. So you're only taxed on the real gain, not the inflation component. And that's basically a return to the pre-1999 system.
Okay. And the second being the 30% minimum tax rate on net capital gains.
This one is designed to stop people timing asset sales into a low-income year. So let's say, for example, after retirement, to pay little or no tax on the gain. If your marginal tax rate is under 30%, then the gain still gets taxed at 30% minimum.
Whereas before it would have been
probably
on less amount.
Exactly, yeah.
Yeah.
And the transition rules are actually generous, so let's be fair about that, you know.
Yeah, so up until the 1st of July, you've got 12 months. The old 50% treatment is still applied. So it's only to anything after that date. So 1st of July is the dividing line, which does bring in another point. What about valuations, Min?
Well, everyone who owns an invested property should get a valuation done on their property for sure, yeah.
Sooner rather than later.
Yeah, exactly, yeah.
Otherwise, everyone's going to be scrambling to do it in June, and you don't want that because there's just not enough valuers out there, or it's already a timely process.
And by the way, just to name drop, Debbie, property scorecard, what is that?
Not a valuation system, but it is definitely something that an investor who is looking to get into something, to get into property, can use to just make sure that the property, the location all stack up. We'll be talking about that in detail in another episode.
Yeah, so we've just launched a new service called Property Scorecard. Website is www.propertyscorecard.com.au. I guess Debbie, it's an offshoot of our SDA advisory business, isn't it, Debbie?
It is.
Yeah. So if for those of you who are thinking to offload or buy or get a second opinion on a property that they are owning or thinking about selling or thinking about buying, then engage our services. We can do a report fee for service to be able to help you out with an assessment on a property or location. So again, more to come in our next episode or two in the future. But for now, we'll just move on from there.
Yeah. So, and just to confirm that with this whole CGT free treatment, your family home, of course, is exempt. It's only on investment properties. Or your main residence, I should say, is exempt. So let's look in a bit more detail on this SMSF lending ban.
Hey, Debbie, I wanna jump in for a quick second here just to let our listeners know. Are you aware of the widow tax?
Of the what tax?
The widow tax.
Not
or death tax.
Yeah, I'm aware of it. I'm not really up on what it does.
So let's just say that a person, husband and wife, who owns a couple of properties from 10 years ago, they're retaining their tax benefits and negative gearing, whatever, right? And the negative gearing benefits there. If the husband dies in a few years' time, all those grandfathered exemptions that the wife, the widow, has is removed. So even in death, the Labor government is trying to tax or remove your tax benefits as well. So that's also a little hidden thing that's come through the last few weeks, but people are not aware of as well. So be conscious of that.
You'll really need to take your accountant's advice on all these new changes.
So where were we?
We were just going to talk in a bit more detail about the SMSF lending ban.
Look, I don't want to spend too much time on it because it's going to be banned. It will come in place in the next 3-4 weeks, right, Debbie? So
4 weeks or so.
It's essentially
10th of August.
Yeah, it's just in limited recourse borrowing loans will be grandfathered in. That's fine. And then as of 10th of August, 11th onwards, then no more borrowing in super to buy property. So residential property, commercial is fine.
Yeah. So if your fund already holds residential property under an LRBA, nothing changes. You're not forced to sell, unwind or restructure. The legislation explicitly protects refinancing of pre-existing borrowing. So if your lender exits the market, you can move on to another lender without losing your grandfathered status. If your fund exchanges contracts before the commencement of this new ban on the 10th of August, you're protected, even if settlement happens after the ban. What's not changed inside super? So SMSFs can still buy residential property outright without borrowing. The classic business owner strategy of holding your premises in super is untouched. Super's tax settings are unchanged, 15% on income and accumulation, 0 in pension phase, and the CGT concessions were deliberately excluded from the budget reforms. So it's only about borrowing to buy residential property in your SMSF. So I guess that kind of really sums it up. If you're in mid-transaction right now, Min, make sure you get that contract exchanged before the 10th of August.
As long as it's signed and countersigned by buyer and seller by the 10th, then you're all good. The government's not saying you have to get the loan in place or have to settle. No. It's just as long as it's signed and in a future date, a year, 2 years, 8 months from today, after the 10th of August, then you'll be okay to get your loan.
Yeah. So I guess that's it. That just is a bit of a summary of the recent changes in the financial world of investing in property. Obviously not specific to SDA, but all property investment. I hope that gives you a little bit more clarity on what it actually might mean for you. Very important to talk about this with an accountant, financial planner, solicitor, obviously, just to make sure you're covered with how any of the changes might affect you personally. All right, Min, anything last to add?
No, there is one more thing. Are these rules forever? No, only as long as the Labor government is in power.
And until such time as another government changes things up again.
And the next federal election is the May 2028, 2 years from now. If another majority or a minority party, let me rephrase it. If another party comes in and wins the election, the federal election, then they may and could and should reverse these rules. However, if the Labor Party wins a majority or minority, seats of power in the Senate, then they could obviously come back again for another 4-year term, in which case we'll see this for at least 6 years from today. There's a potential. So either 2 years from now we'll see Labor removed, or maybe 6 years from now we'll see Labor removed. But either way, these rules are not forever. They're in place for now until such time a party will remove it or modify, amend it. Yeah.
If they so feel the need to.
Yes. But there's a lot of backlash, Debbie, because we are in a housing crisis. We know that. We do have a migration policy of bringing in more, migrants. So the offset of, let me rephrase it so I'm saying correctly here. There's about 350 to 450,000 migrants coming into Australia every year, I think, is the numbers, rough numbers. And there's probably 100 to 150,000, I'll call it 120,000 leaving Australia every year, right? So the net probably about 300,000-ish, give or take, a few thousand, is new people who need to find new housing, right? So if we're already in a housing crisis, residential housing crisis, and supply will slow down because of, again, interest rate rises and legislation changes by the government and supply chain delays from overseas because of, the Iran war or Ukraine war or whatever, supply delays occurs, then we're going to see a slow down effect of construction, of building, of houses and housing in Australia. So that will obviously create a further pressure on the rental prices. So we've seen the last 5 or 6 years now rental increases of about 9% per year. That's rental increases every year. And with all these changes and inflation and interest rates and supply chains, I don't see that changing anytime soon. So much so that I think we'll see 20 to 30% increase of rents in the next 2 years around Australia because of the lack of supply. So that's all I have to say for now, Debbie, on this topic, because all this does impact upon everything with regards to housing, residential property. And I hope that our listeners have gotten some positive, not positive, but
some clarity
on this topic.
Yeah. Okay. Well, thanks for that, Min, and we will chat to you all again next time.
Bye-bye.
We hope you enjoyed this episode. Please make sure you are subscribed and following us so you can keep in the loop with all of our upcoming episodes. We would really appreciate it if you could leave us a 5-star rating, a written review, and to share this podcast with those that could benefit. Until next time, catch you on the next episode.